Welcome to our bonus video. This bonus equity video is basically going to be done to give you a summary of all the different equity transactions that you should have learned throughout the entire chapter. So it's your one-stop shop for all your equity needs. So the first thing we learned about is issuing common stock. So when we issue common stock, I'm going to do two things. I'm going to do my journal entry and then the A equals L plus the effect. So when we issue stock, what happens is our assets go up and our equity goes up. And in order to do our journal entry, we're going to debit cash for the number of shares times the selling price. That increases our assets. The X's are just a placeholder for numbers. We're going to credit common stock for the number of shares times the par, which increases equity. And then additional paid-in capital would be the difference to balance out my journal entry, which also increases equity. In addition to issuing stock, we learned about purchasing treasury stock. So when we purchase treasury stock, it has the opposite effect of issuing stock. Under our accounting equation, assets are going to go down and equity is going to go down. And when we record it, we're going to debit treasury stock for the number of shares times the purchase price, which decreases equity because treasury stock is a contra equity account. And then we're going to credit cash for the same number of shares times the purchase price, which decreases our assets. When we resell treasury stock, this is where it gets a little tricky. You have to remember to take it off the books for what you put it on at. So we're going to debit cash for the number of shares times the selling price, which increases assets. So I should have done my accounting effect here. Assets are going to go up and equity is going to go back up. And we're going to credit treasury stock for the number of shares times, and I'm going to change the color because of the importance, the purchase price, which makes equity go back up. And then we're going to credit or debit, it depends, additional paid-in capital for the difference to make it balance. So most of the time it'll be a credit because we usually resell our stock for more than we paid, but it is possible that we need a debit to make it balance. So remember that. Now this should make some sense because when we issue stock, assets and equity go up. When we buy it back, the opposite happens. Assets and equity go down. And then when we resell it, assets and equity go back up. So there's some logic behind all of this. But remember, when we resell our treasury stock, we've got to remember to take it off the books for what we put it on at. In addition to those transactions in equity, we also learned about stock dividends. So when we have a stock dividend, there's either large or small stock dividends. So the first thing you need to know with stock dividends is how to get the number of new shares. So the number of new shares for a stock dividend equals the number of shares outstanding times the stock dividend percentage. And then you should also know that small means it's less than or equal to 20%. Which means we record it at market value. And for big, it means it's greater than 20%. And I realize I did my crocodile wrong here. Small is less than or equal to 20%. Big is greater than 20%. And that means we record it at par. When we do our entry, no matter if it's big or small, all that happens is we're moving money out of retained earnings into contributed capital. So retained earnings goes down, contributed capital goes up, and the net effect is 0. So with that said, our journal entry is going to be debit retained earnings for the number of new shares times par, if it's a big, or market value, if it's a small stock dividend. And that decreases equity. Then we're going to credit common stock for the number of new shares times par, which increases equity. And then if needed, we'll use additional paid-in capital for the difference. We're only going to need that if we're dealing with a small one recorded at market value, because if it's recorded at par, there will be no difference between retained earnings and common stock, and that also makes equity go up. So in the grand scheme of a stock dividend, all we're doing is moving retained earnings into contributed capital. There's no net effect or net change to our equity. If we're dealing with a stock split, remember no entry is required. All that happens is our number of shares in par change with the stock split. So let's do an example of a 4-4-3 split. Whoops. So with a 4-for-3 split, if the number of shares before was 100 and the par was 5, the total common stock would be 500. To figure out the shares after the split, we'd multiply by our stock split ratio, which would be 4/3. So we take 100 times 4/3. That gets us 133.33. Probably didn't pick the best example. And then to do our par, we multiply by the reciprocal, which is 3/4. So 5 times 3/4 is 375. And then if I multiply that by 1.33, 133.33, I get 500. So before and after a stock split, total common stock remains the same. No journal entry is required. All that happens is the number of shares and the par value changes. To figure out how to get the new number of shares, you multiply by the stock split ratio, which in this case was 4/3. And then to get the new par, you multiply by the reciprocal, which is the flip version of that ratio. Lastly, let's review preferred stock dividends. So with preferred stock dividends, they can either be cumulative or non-cumulative. First thing you need to know is, how do I get my preferred stock dividend? The preferred stock dividend equals the number of shares of preferred stock outstanding times the par of the preferred stock times the dividend percentage. And then once you have that, you got to figure out who gets the dividend. So in order to figure that out, I always start with total dividends declared. Then I take out my current year preferred stock dividend. Then I take out any prior year unpaid preferred stock dividends, but that only applies if it's cumulative. And it's also important to remember these are called dividends in arrears. And that gets me my leftovers for common stock. So let's say the number of shares outstanding were 1,000. The par value is 100 and the dividend percentage is 6%. So just as an example, we would take 1,000 times the 100 times the 6%, and we would get a $6,000 preferred stock dividend. If total dividends declared were 30,000, then we get the current year preferred stock dividend, which is 6. Let's say there's 3 years of dividends in arrears, and then let's do non-cumulative and cumulative. And I'm going to erase dividends in arrears just to make more room. So if it's non-cumulative, then we have the 30,000 declared. They get the current year preferred stock dividend. Even though there's 3 years of dividends in arrears, I don't care about it because their non-cumulative dividend preference means they don't get any of the old ones, which means the leftovers for the commoners would be 24,000. If it were cumulative, the 30,000 is declared. The current year amount would be 6. The prior year amount would be 6,000 times the 3 prior years that were unpaid, which is 18. And that would leave the remainder as 6,000 for the commoners, and the preferred stockholders would end up with 24,000 in that case. So again, it's important to remember with preferred stock dividends to know if it's cumulative or non-cumulative, and then to figure out if the question's asking for the amount the commoners get or the amount the preferred stockholders get. The commoners is what we get at the bottom if we do it this way, and then the amount that the preferred stockholders get would be the current and any prior year amounts that are included in the calculation. So hopefully this helps as a nice review of all the equity transactions all in one place. You may notice we didn't do a journal entry when it came to preferred stock dividends, and that's because the journal entry would be exactly the same as regular cash dividends, where we debit retained earnings. And in fact, I just realized I didn't go over this. So let's go through the dividend entry. Whether it's preferred stock or common stock, the dividend entry is going to be the same. There's 3 dates. First is the declaration date. On the declaration date, we're going to debit retained earnings for the amount of the dividend, which decreases our equity. And we're going to credit dividend payable for the amount of the dividend, which increases my liabilities. Then on the date of record, that's just the date that you have to own the shares to get paid, so there's no entry. And then we have the payment date, which would be debit to dividend payable to reduce the liability for the amount of the dividend, and credit cash, which reduces assets, again, both for the amount of the dividend. So that should be it for all of the major components of equity. Hopefully the review was useful. There's also an equity study guide you can refer to on Canvas, which summarizes all of these important items as well. As always, please use the resources on both Canvas and Connect to practice. There's plenty of practice problems available, and then reach out via the discussion boards for any questions that you may have.